All right, let's talk about SmartRent's latest quarterly earnings. At first glance, the numbers looked, well, pretty rough, and the stock took a hit because of it. But, that initial reaction might not be the whole picture. So let's dig in.
Yeah, the pre-market numbers looked bad. We're talking big misses on revenue, big misses on profit, and that pretty much set the tone before the opening bell even had a chance to ring.
So, first things first, let's look at the top line. Revenue came in at $38.3 million. That is a 21% drop from last year. And a drop that big, well, it sends ripples through a company's entire financial story.
And things didn't get any better on the bottom line. You see, Wall Street was expecting a loss of about 4 cents a share. SmartRent came in with a loss of 6 cents. Now, you might think it's only 2 cents, who cares? But for the market, it's a signal, and not a great one, about the company's path to actually making money.
Okay, so revenue miss, earnings miss, stock prices down. Seems like an open and shut case of a really bad quarter, right? Well, maybe. That's what we're here to figure out. Was this just a classic fumble, or was there something else going on entirely?
Let's start by just laying out the facts. Here are those headline numbers that got everyone so worried.
So beyond just the earnings and revenue misses we talked about, look at gross margin. It got squeezed by 260 basis points. That's 2.6%. And then there's adjusted EBITDA. It swung from a small profit last year to a $7.3 million loss this quarter. That's a huge $8 million negative swing, and it really shows the financial pressure this company is feeling. So what did the market do? Well, it didn't wait around to ask questions. Traders saw these numbers and immediately started selling, pushing the stock down almost 8% before management even got on the phone for their earnings call. The verdict was in before the defense could even make its case.
But this is where the plot thickens, because management's story is that this quarter wasn't an accident. They argue it was actually a necessary, if painful, step in a massive change in strategy.
And this right here, this is the core of the entire story. SmartRent is intentionally stepping away from those big one-off hardware sales. Why? Because, frankly, the profit margins are thin, and you never know when the next sale's coming. Instead, they're all in on software as a service, or SaaS, which brings in that stable, predictable, recurring revenue that Wall Street absolutely loves. So think about it this way. The old way was like being a contractor. You do one job, you get paid once. The new model is like selling a subscription. You build a customer base that pays you every single month. It's a huge shift from lumpy, unpredictable sales to a much more stable and hopefully much more profitable business. That pain we saw in the Q2 numbers? Management is saying that's a direct side effect of making this switch. And this isn't just talk. You can literally see this pivot happening in their numbers. SaaS and hosted services now make up almost half of their entire business. Even more impressive, that high-margin SaaS revenue is now 37% of the total pie. Just a year ago, it was only 26%. This is real, tangible proof that the strategy is working. And the SaaS business itself looks really healthy. Annual recurring revenue is up 11% from last year. But check this out. This is a huge indicator. Net revenue retention is at 108%. Now what that means is, even if they didn't sign up a single new customer, their revenue from their existing customers is still growing by 8%. That's a powerful sign that they have a really sticky product people want more of.
So look, a better business model is great in theory, but it doesn't pay the bills by itself. So what's the plan to get back in the black while all this change is happening?
Step one is getting aggressive on costs. The new CEO, Frank Martell, basically said they're taking a scalpel to the budget. The goal is to slash at least $30 million in yearly costs by making their operations smoother and cutting back on staffing and outside consultants. So management has laid out a really clear two-step game plan. First, you reset your costs. Get lean. Second, you use those savings to hit a massive milestone, becoming cash flow neutral by the end of 2025. In plain English, they want the cash coming in every month to be equal to the cash going out. They want to stop burning money. And the good news for them and for investors is that they have the cash to see this plan through. The company is sitting on $105 million in cash, they have zero debt, and they can tap into another $75 million if they need it. They're so confident, in fact, they bought back over 4 million of their own shares last quarter. That's a pretty big signal that management thinks their own stock is a bargain. So let's put it all together. When SmartRent reports again in 3 months, what should we be looking for? What's going to tell us if this painful strategy shift is actually paying off? Here's what's on my watch list. First, SaaS growth.
Does that slice of the revenue pie keep getting bigger? Second, margins. Do they start to improve as those low-profit hardware sales become less of a factor? I'll also be watching a metric called units booked to see if they're landing new big customers. And finally, I'll be listening closely for any updates on their AI infusion, how they're using AI to get more efficient and build new products.
Okay, after digging through all of that, our rating on SmartRent is market perform.
And here's why. The pro is obvious. They are shifting to a way healthier business model that should be much more valuable in the long run. The risk? Well, there's a ton of risk in pulling off a transition this big. The cushion, though, is that rock-solid balance sheet. It gives them a financial safety net and time to get this right. It's a textbook case of short-term pain for potential long-term gain.
So the big question for investors is really about patience. Can management execute this turnaround before the market gives up on them? We'll be watching for those proof points on the next call. Now, as always, this is for informational purposes only. It is not financial advice, so please do your own research.